All right. Hey guys, welcome back. Welcome back. I can see everyone slowly flowing in once again. And if you guys are joining us just right now, or you have come over from the previous room, previous session with Margaret, whatever it is, welcome. We're going to kickstart the third session of our first day. This is obviously Market Insights Virtual Summit Q2 for 2021. We're looking at the opportunities and challenges ahead in this quarter. So let me just go ahead and share the screen. Previously, we had quite a huge turnout for the first two
Yeah,
sessions.
we have about 800 to 900 packs in the webinar room. So we are near to 1,000 people on this summit. That's fantastic, guys. Thank you, you guys, for all the support. Right?
Yeah.
And we have Rayner in the house.
Yes,
How many of you guys are here just to support Rayner? Please type a yes in the chat.
I think we have a lot of our attendees joining who are Raina's subscribers.
Yeah, right.
Amazing.
Okay, so right now we have about 380 people. So just wait for a moment, the people will start streaming in slowly, all right? And we have Rayner in the house, right? Meanwhile, Jeremiah, you want to stream your presentation as in the PowerPoint slides?
There we go. Can you see the screen?
Yes, I can see the screen.
All right, perfect. So for the benefit of those that are still joining us for the first time, maybe you missed the first two sessions for whatever reasons, I want to welcome everyone to the Market Insights Virtual Summit of second quarter. We are second quarter of the year 2021. It feels like time is passing by very quickly, but that's also a good thing, I guess, and things are improving. And so we're looking at the opportunities and challenges ahead for the rest of the year or for the next quarter. And at this point, this is happening obviously today, Saturday, 27th of March, and also happening tomorrow on the 28th of March. And the first two sessions we started at 10 a.m. And now we're on our third session. Before we kind of get into things, I just want to let everyone know that do follow us on our Facebook and Telegram channels. The Telegram channel and the Facebook group has a lot of updates and a lot of constant information that we're flowing. And whenever we organize events or whenever we do anything, we're always updating those channels. So be sure to kind of join those social channels. I think Alex would have posted a link.
Yes, I posted the link in the chat box.
Yep, and also with Telegram as well. We also do conduct like live streams occasionally here and there. So it would be nice if you're interested in that to always be updated on updates like this. And we also give sometimes our market outlook as well. So do follow those two channels, okay? Next up, this event, one of our sponsors is IG, and we're very proud to kind of be collaborating with them to actually push out this exclusive promotion. So you can see here that for just exclusively for attendees of this event, there is a promotion where you can get $100 credit when you open a new account with IG. And obviously this is for Singapore residents. So anyone with a Singaporean address, a residential address here will be eligible. And all you need to do is you need to fund at least $500 into the account and trade at least once in 30 days. And you also can get a free physical copy of the Trader's Blueprint. I'm not sure if you have heard about it, but I personally think it's an amazing book. So it'll be quite fun or quite interesting to get your hands on that and kickstart your investing journey. And the last thing I want to talk about is what's upcoming next for us. Now, we have a lot of exciting things, and we always are constantly hosting events and making sure you guys are engaged. And the next Market Insights Virtual Summit is happening on July, on the 10th and on the 11th. And for this upcoming session, we have some really, really cool guests. We have Tom Basso from Trendstat Capital Management, and we also have Michael Koval from trendfollowing.com. Now, both of them, I'm not sure if any of you follow them. Maybe if you do, you can share your experience, but they are excellent speakers and excellent experts in their domain. So I do encourage anyone of you who's interested to join us for the next summit. Alex, I think also would have posted the link to the sign up and registration.
Yes, posted in the chat box as well.
All right, thank you so much, Alex. And yeah, so with that, I think this is a session that I'm highly looking forward to. If you guys don't know who our speaker is, I'm very, very excited to be introducing him. And he is none other than Rayner Teo. He is obviously the founder of Trading with Rayner. And if you guys are active in the space and keeping up to date with anything that's in the trading space, you would know that he is actually the most followed trader in Singapore, with more than 100,000 traders reading his blog every month. In fact, I think some of you might be part of that 100,000, and also more than 1 million YouTube subscribers. That's absolutely incredible, absolutely amazing. Some of you are probably his subscribers as well. If you are, maybe you can just say hi. That would be interesting to hear from you guys. But yes, Rayner Teo today, he will be sharing on how to profit from the stock markets in less than 30 minutes a day. And what I identify very well with is, even if you've tried everything else and failed, that's something that I'm not sure if any of you can relate to. But I think at any point in part of your investing journey, you might have been there. This is the session to kind of really get some insights into profiting from stock markets. And I think Rayner is the best candidate to actually bring that information to us. So with that, I'd like to welcome Rayner. Rayner, are you there with me?
Yep, I'm here. Can you all hear me?
Yes, we can hear you. We would love to see you as well. If you can turn on your video.
All right, let me see this one. There it
There
is.
you
Is it?
Hey, Rayner, how are you, Rayner?
Hey, everyone. I'm doing good. Thank you so much for introducing me, Jeremiah.
No problem at all. I first of all, I really love the shirt. A great way to kickstart Saturday afternoon, especially for our fans out there of comic books. But anyway, Rayner, thank you so much for joining us today, and we're all very excited for your segment. And with that, I will leave all of our attendees in your hands, and I'll let you take it away.
Sounds good. Let's do this.
All right, thank you, Rayner. Go ahead.
So, all right. So I need to share my screen. Okay, let's see.
That's correct. You can go ahead and share your screen.
Can you see the slide?
Yes, we can see.
Okay, great. Okay, so welcome everyone. So first and foremost, I'd like to thank MarketWise, Jeremiah, Alex for inviting me to MarketWise and to be part of this this summit. So my presentation, it's stock trading secrets, how to beat the markets in less than 30 minutes a day without getting killed in a bear market or a recession. So without further ado, let's get started, right? So to kick things off, I think some of you might not be familiar with the things that I do. So just walk you through some background that I have. So it all started back in university days. I was from SIM Global Education. So it's one of the private uni in Singapore, because my grades were not good enough to go to local U. So yeah, that's where I was in that school. And one fine day, a broker come down and organize a trading competition. So I figured, how difficult can this be? So I signed up for that competition. Within 2 days, I blew up the trading account. It's on demo, fortunately. And that's pretty much kickstart into my foray into trading. So at university, I knew that there's only one path that I wanted to do, for my career, and that is trading. So after graduation, I was looking high and low for a job in proprietary trading, and it took me quite a while, I think a good year or so, and finally landed it in a proprietary trading firm. As you can see over here, this is me back then, I would say. Maybe when I was 20, possibly 26, 27, around that age. And yeah, that was where I was in the firm, learning about prop trading, was there for about a couple of years. And at prop trading, I had some free time to, share my thoughts about the market. So I had a very small blog back then. It was called Trading with Rayner. And that was where, the blog was, alive and well. So when I left the firm, right, I had more time to kind of dedicate to the Trading with Rayner, the blog, the business and stuff like that. So that's where, you see more content coming up from me and stuff like that. So that is where, kind of like the birth of Trading with Rayner really started only after I left the prop trading industry. So Trading with Rayner is pretty much me, working from home. So you can see that here is pretty much where I am right now. This setup is just very simple, chairs, table, and the monitors that you see over here. This monitors that you see, it's actually the same one back then. So I simply bought this from my boss back then at the firm, and I just got it at a really good price. And yeah, so that's pretty much my setup right now. So that is kind of like my background story to how I got started in trading. It all started back in uni days, got into prop trading, and to where we are right now. So along the way, I've feedback from some traders, like for example, you can see here Damien. Hey, my friend, just want to say thank you for your time to put this free training together. They have helped me understand the basics to analysis, reading candlesticks, patterns, My account is now up 10% in 4 weeks thanks to your insight, etc. So you can see, right, there's a lot here. I'm not going to go through every single testimonials because today's training is not about me, it's all about you. Okay, so let's just kind of skip this one. So now the question is, what are we going to cover today, right? So I'm going to give you a broad overview to what I'll be sharing today. So number one, I'll share with you the easiest way to make money from the stock markets, and it's not what you think. So I call this secret number one. Secret number two is how to instantly increase your returns, right, while reducing your risk using this one simple technique. And secret number three is how to become a winning trader, even though you do not know what the market is going to do next or whether the next trade is going to be a winning trade or a losing trade, and much more. I don't want to spoil the fun here with you. So with that said, let's get started. So first thing, right? Secret number one, the easiest way to make money from stock trading. So if you look at it, right, when you trade stocks or you trade other markets, there's only really two ways you can profit from the market. Number one is to buy low and sell high. That's something that you are all very familiar with. And then there's another option which is called buy high and sell higher. That's another option that you can do. But now the question is, right, it's not which approach is better or which approach is works, because both of them clearly works. But let's say from a stock trading standpoint, which approach is better? Because both of them can make money. Buy low, sell high, like Warren Buffett. Buy high, sell higher is like a trend following approach. So now in the context of stock trading, right, which approach is better? So let's analyze this. So number one, what we're going to do is we're going to run a simple back test across the US stock markets and let the data speak for itself. And to do this back test, the first one we'll do is to buy low and sell high. So the first rule is this, right? We'll go long when the stock hits a 50-week low. So what do I mean by when the stock hits a 50-week low? So I'm just going to draw a simple thing out. So for example, let's say the stock is declining down lower, lower, and lower, and then it hits this price point. Let's say this price point is the 50-week low. Some of you might be wondering, hey, Rayner, what is 50-week low? It simply means, right, that the current stock price is the lowest price over the last 50 weeks. Simple as that. The lowest stock price over the last 50 weeks. So that's what we mean by we go long, we buy a stock when the price of a stock hits a 50-week low. So moving on, our exit rule is a 20% trailing stop loss. So again, let me illustrate what this means. So let's say a stock goes down lower, and it hits a 50-week low at this price point. Let's say this price point is at $100. Okay. So how does this 20% trailing stop loss comes into play? Very simple. If this is at $100, our 20% trailing stop loss means, right, our stop loss is 20% of this value. So clearly, right, 20% of $100 is $20. So if the price drops another $20, let's say it drops down to this point, which is $80 over here. Okay, this means that we will exit the trade. So let's put it across. We will exit the trade when it drops to $80. So from $100 to $80 is a 20% drop in price. We will then exit this trade. Now, what if, okay, let me just do with you another variation of the example. Let's say the price goes down lower to the 50-week low. You buy over here, and then you catch the bottom. The price heads up higher now. And right now, let's say initially you got it, it was at $100. Okay. And now the price has bounced up to a high of $200. So how does this 20% trailing stop loss work? Same concept, right? What we'll do is we'll take the highest price point that the stock has went to and calculate 20% of that value. So 20% of $200 is $40. So if the price of the stock were to drop $40 from the highs right now, let's say this is a $160 price point. Let's say the stock were to drop, right, from $200 down all the way down to this price point at $160. It means our 20% trailing stop loss is hit and we'll exit the trade. So this is pretty much the two ways the stock can go. If it drops down lower and hits our 20% trailing stop loss, or it goes up higher, then it reverses and then hits our trailing stop loss. Okay, so this is what this means. So the next rule to share with you is this. Sometimes when a stock, right, all of them drop at the same time, right, there are many stocks to choose from. So how do we filter the stocks to choose? So what we'll do is we'll pick the top 20 stocks that has the largest price decline over the last 50 weeks. So in essence, what we're trying to do is we are trying to buy the weakest of the weakest stocks, right, whenever it hits the 50-week low. Okay, and we have 20 positions at most. So some parameters to make the backtest more real. Our transaction cost is 1 cent per share, which is highly achievable when you're trading the US stock markets. We will test this all only in the US Russell 1000 stocks, the largest 1000 stocks in the US. We will execute the trade at the market open when the market opens. Our position size is 5%. So let me explain what this means. So unlike our traditional, 5% stop loss, right? What this one means is that let's say you have a capital of $100,000. So a 5% position size means that each stock will not be more than $5,000. Okay, let's call it 5K. So this is what we mean. So let me repeat once again. If let's say you have a capital of $100,000, the position size 5% means, right, that each stock that you buy, the value cannot exceed more than $5,000. So let's say you want to buy stock A. Okay, let's say the stock A. Let's call it stock A. And stock A, the current stock price of stock A is at $5,000. So how many shares of stock A can you buy? The answer is 1. Because remember, our value of each stock cannot exceed $5,000 if we want to make sure that our position size remains 5% of our total account value. So now let's say what if we have stock B, and this time around stock B, the share price of stock B is $500. How many shares of stock B can we buy? We can buy, okay, let's change this to B. We can buy 10 shares because 10 multiplied by 500 is equals to $5,000. So this is what we mean by, position size 5%. And by doing this, right, we won't allow any one stock, right, to kind of be holding too much weight in our portfolio. So for example, if you buy 10 shares of Amazon and you compare with 10 shares of McDonald's, it's not going to be equal because the price of Amazon is so much higher than McDonald's. So if you buy 10 shares of Amazon, right, your portfolio weightage will be more leaning towards Amazon than, McDonald's. So this is what we're trying to, overcome over here. We want our portfolio to be equally distributed among, these 20 stocks out there. Okay, so this is what I mean by position size 5%. And then moving on, our back test period is from 1990 to 2018. So that's about 29 years, taking into account the financial crisis, dot-com bubble, etc. So you can see over here the results of the buy low and sell high. Number of trades you have taken over the last 29 years is 467. Winning rate is about 43.68%. Annual return is about 9.28% with a maximum drawdown of 52.27%. So let me break down these numbers for you, as some of you might not be familiar with it. So what, as number of trades, as a winning rate. Annual return, how do we define this annual return? So very simple. Let's say you have a starting capital of $100 and let's say your annual return is 10%. So you made 10%. So $100 you add on 10% will give you $110, an increase of 10%. So let's say you make another 10% in year 2, this value now becomes not 120, but $121 because we are taking 10% of this second year value. So the 10% of this 110 is $11. $11 plus $110 gives you $121. So over these 2 years, right, we have an annual return of 10%. So what this number means is the annual compounded return, right, over the last 29 years is about 9.28%. So maximum drawdown, what does maximum drawdown mean? It's very simple. So let's say you have a portfolio value of $100,000. When you have a maximum drawdown of 52%, or let's make it simple, 50%, it means that $100,000 at one point in time was only worth $50,000. That is what we mean by having a drawdown of 50%. So in this case, a maximum drawdown of 52%, it means that your $100,000 at one point in time was only worth $48,000. So this is what we mean by maximum drawdown. So this is the results of buy low and sell high. So now let's move on and have a look at buy high and sell higher. How much of a difference would that make? Would it be better or would it be worse? So again, we'll go long when the stock hits a 50-week high. So this is now the opposite. Previously, we were trying to buy when the stock price fell. So now we're trying to buy when the stock price goes up. So let's say stock is in an uptrend and it breaks out of the 50-week high, we buy. Okay, so now you can see that this is the inverse, right, of what we did earlier. Next thing, we have a 20% trailing stop loss exits. So it's again the same concept which I shared with you earlier. So I'll just briefly do this. If you buy at, let's say, a 50-week high, let's say the price is at $100, right? If it drops 20% to $80, you exit the trade. But what if it continues to go up higher? Let's say now it goes up to $300. Where is our trailing stop loss? Now, simple, 20%. So 20% of $300 is $60. 300 minus $60 is $240. So if the price now reverse to, let's say, $240 at this point, okay, it will exit the trade. I'll put it across over here. It means you'll hit your trailing stop loss and exit the trade at $240. It's a bit messy, but you get my point. So that's what we mean by the trailing stop loss. And again, sometimes, right, in bull market, many stocks will hit their 50-week high at the same time. So which do we pick? We simply pick the strongest one, the top 20 stocks which has increased the most in price over the last 50 weeks. Simple. This is how we kind of filter down, which are the strongest stocks to pick. So again, transaction cost, test universe, market open, all the same as earlier. And here are the results. Number of trades. Now, the one in bracket or parentheses, right? This is actually the results from the previous backtest, the buy low, sell high. So the current results is the one bolded over here. So you can see for buy high, sell higher, you have taken 707 trades compared to 467 earlier. Winning rate has increased slightly to 48.66% compared to 43.68% earlier. Annual return has increased to 12.81% compared to 9.28% for the buy low, sell high backtest earlier. Maximum drawdown has been reduced to 40.75% compared to 52.27% for the earlier backtest. So you can see that at this point in time, the buy high, sell higher, right, seems to be, a better trading approach when it comes to stock trading. So if you want to see the table of results, right, this is pretty much the results on a month-to-month, year-to-year basis over the last 29 years over here. Okay, so I won't recommend you trade this on its own, but you can see that clearly this thing to share with you is it's easier, right, to make money buying stocks in an uptrend, not in a downtrend. So this is the first secret that I want to share with you. Second secret, how to instantly, right, increase your returns and reduce your risk. So here's the thing, right? Many traders think that, Rayner, to increase your returns, you have to increase your risk. Well, not quite, because I'm going to share with you this very simple technique to actually, increase your returns while reducing your risk. So to do that, right, I'm going to share with you this picture of the sea, the ocean, whatever you want to call it. And because the secret lies in this image over here. Can you figure what it is? So let me share with you. And it's actually quite simple because out there in the sea, when the sea tide goes up, the ships in the sea goes up as well. Right? It's common sense, right? When the tide goes up, the ships goes up. When the tide goes down, when the sea levels go down, the ships which are on the water goes down as well. So what has this got to do with stock trading? Simple. You can imagine the sea. I'm just going to draw. You can imagine this on the sea over here as the market. And you can imagine all these little ships over here, ships, as individual stocks. So if the market is bullish, it's going up higher, stocks tend to go up as well. And if the market is in a recession, it's in a bear market, all these individual stocks tend to go down with it as well. So as a stock trader who wants to put the odds in your favor, you want to be only trading when the market is bullish. How do you do that? Simple. Let me share with you this technique. This is what we call a trend filter. I didn't come up with it, right? If you follow any trend following books, like, books from Andreas, Kleno, Nick Reg, etc., this is a concept they have, shared. And I'm just, learning from this, great traders way ahead of me. So how you can use this trend filter for your own trading is, again, depending which markets you're trading. If you trade US stocks, you can refer to the Russell 3000, which is simply the largest 3,000 stocks in the US stock markets, or the S&P 500. It's up to you. If you trade Singapore stocks, you can refer to the STI, Straits Times Index. If you trade the Philippine stock markets, you can refer to the PSE. Okay, so how do we use this trend filter? So first and foremost, right, let me just kind of, prove it to you, right, how a trend filter can improve your trading results. So let's do a back test again, but this time around, we apply a trend filter with it. So again, the rules are the same, but we'll apply a trend filter. So we will only buy if the Russell 3000 index is above the 100-week moving average, or else we stay in cash. So this is to help us define, right, hey, is the broad-based market in an uptrend or a downtrend? So we will use the Russell 3000 index. In this case, you can use the S&P 500, you can use the Russell 1000, it's up to you. I'm just going with the Russell 3000 index. And since if it's above the 100-week moving average, we will say that, hey, the overall market is bullish, let's look for some buying opportunities. But if the Russell 3000 index is below the 100-week moving average, we will say that, hey, this market is bearish, we'll remain in cash. So again, the rules are the same. We go long when the stock hits a 50-week high. Our exit rule is a 20% trailing stop loss. And our filter is, again, sometimes there are too many stocks to buy in a bull market. We just simply choose the top 20 stocks that has increased the most in price over the last 50 weeks. So let's have a look at the results. Number of trades, right? So, okay, let me just walk you through. 905, the one in bold, is this current backtest, right? Buy high, sell higher with trend filter. The one in parentheses in bracket is referring to the previous backtest, which is the buy high and sell higher. So in this case, we have more number of trades, 905. Our winning rate has increased slightly to 49.17%. Previously, it was 48.66%. Our annual return has further increased to 15.7%. Previously, it was 12.8%. Maximum drawdown has been now reduced to 35.08%. Previously, it was 40.75%. And if you look at the table, the month-on-month, year-on-year results, you can see that this results is really looking much better than what we have seen earlier. So yes, we have losing years along the way, but these losing years now have become more manageable. And if with a little bit of tweaking, we can even make this into a quantitative trading system. But that's a topic for another day. So the secret number 2 that I want to share with you is that a trend filter can improve your returns and reduce your risk. And I'll show you later how you can actually apply this concept to your trading and get results with it. So now moving on to secret number 3. Secret number 3, how do you be a winning trader without knowing what the markets will do? Because let's face it, right? Often we have trade and we have seen traders saying that you even if you do not know what the markets are going to do next, you can still make money in the long run. And they just can't grasp that concept. How does that work? Well, the secret is this, all right? So let me just give you a live example to help you understand this concept. So imagine this, right? That I'm going to, this series of trades appear. Lose, lose, lose. L stand for lose, right? Loss, loss, loss. Win, 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 loss, win. So imagine you are going to take the next 8 trade and it comes up with this a permutation. Right, first 3 trades are losers, next 3 trades are winner, then lose, then win. And you really have no idea whether the next 9 or 10 trades is going to be winner or loser because it's pretty much random. So how do you be a winning trader, right, when you have such random outcomes? Because I'm sure you can agree, when you trade the markets, you have probably encountered something similar as well. Lose, 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 win, win, lose, win, 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 lose, 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 and you're wondering what the beep's going on. The result seems random. Yeah, but yes, the results can be random in the over the next few trades, right? But if you have this one thing, right, you will know that in the long run, you can still be a profitable trader. So let me explain. So imagine this is lose, right? But let's say every time you lose $100, right? Let's say every time you lose, it's a negative 100. And every time you win, it's a positive 150. Can you imagine that in the long run, yes, you will have this, random trades popping up here and there, but in the long run, you can be certain, right, that you will make money. You'll be a consistently profitable trader. So if you just do this math with me, right, over here, minus 100, minus 100, minus 100, then when you win, right, 3 wins, plus 150, plus 150, and plus 150. Then you lose and win again, minus 100, and then you plus 150. If you do the math, right, you will know that you will be ahead, right, by $200 without knowing whether, each trade is going to be a winner or loser on the next. So this is really, what matters is that you must have an edge in the markets. And I know that you're probably thinking, okay, Rayner, what exactly is an edge? So you can break down this formula into this, right? Winning rate multiplied by your average gain minus your losing rate multiplied by average loss. I know this formula looks daunting, right? So let's plug in the numbers so it all makes sense. So if you're going to have winning rate, earlier you've seen that, you have 4 winners, 4 losers. So your winning rate is 50%. Your average gain earlier is $150. So you bracket all this up and you minus your losing rate, which is 50%, and your average loss earlier is $100. So you put in all the formula, you realize that your net number is $25. So whenever, with your own trading matrix, right, just plug it all this number in. If you have a positive number, no matter how small, right, congratulate yourself because you might be onto something. So now the next question is, hey, Rayner, how do you actually make sense out of this $25 number? Very simple. So if let's say you were to risk $100 on each trade, every time if you lose 100. Okay, and what this means, right, is that, so using the same examples that we used earlier, when you lose $100. When you win $150. What this $25 signify is that on average in the long run, right, you can expect to make $25 on each trade. Okay, so if you look at this back here again, this example, we have 8 trades taken, right? So 8 trades, if I know that on each trade, I think I can expect to make an average of $25, right, in the long run. So 8 trades multiplied by 25, that's a total amount of $200. And that's the same number which I shared with you earlier. If you go and plug in the numbers like, minus 100, minus 100, minus 100, plus 150, plus 150, plus 150, minus 100, plus 150, you know that in the end, right, that amount is about $200. So again, or else you can use that $25 number which I shared with you. You multiply by the 8 trades that you have taken, you can expect to make about $200 after 8 trades as well. So again, this is the pretty much the logic behind it. So once you have, apply this formula, you want to see that you have a positive number. So when you have a positive number, you might be onto something. You might have an edge in the markets. And this is how, right, you can actually, be a winning trader even though you don't know what the market will do next, by having an edge. So let's do a quick recap, shall we? Secret number one is easier to make money buying stocks in an uptrend, not in a downtrend. Secret number two, a trend filter can improve your trading results and reduce your risk. Secret number three, you must have an edge in the markets. So now moving on, all right, I want to share with you a simple stock trading strategy, right, that works without getting killed in a bear market or a recession. And the best part of it is that this strategy will be based, right, on the 3 secrets, the 3 principles, the 3 concepts that I've just shared with you. So let's get started. So the first thing to look for is trend. So when it comes to stock trading, you really just want to focus on trading trending markets. Why is that? It's simple, right? As you've seen earlier, it's much easier to buy, or rather to make money when the stock is in an uptrend than in a downtrend. So why do you want to fight this natural phenomenon of the stock markets? Why not just focus only on stocks which are in an uptrend? Even range stock markets, just forget about it. Just focus only on stocks which are in an uptrend. And because there are so many thousand stocks out there, you can just simply focus on the best trending stocks out there. And I'll share with you later how to do that. Okay, so first thing first, trend. What trend does is that it tells you what to do. If the market is in an uptrend, you look for buying opportunities. If the market is in a downtrend, then you just stay out of the markets. So how do you do this? So first thing first, stock market index above the 100-week moving average. So what this does is that it tells you what the overall market is doing. Is the overall market in an uptrend or is it in a downtrend? Next thing, you want the stock to be above the 200-day moving average. This tells you what the individual stock is doing. So remember the sea and the ship analogy I shared with you. So the stock market index is like the sea, and the stock, right, is like the individual ship. So when the stock market index is in an uptrend, when the individual stock is in an uptrend, when you trade, you have a much higher probability of success. So let me share with you how this would work. Okay, so let me just go through the charts. Can you all see my charts? So just to do a quick check, because I actually pull out another screen, so I just want to know if you can see my charts. So do I have a chat box over here?
Yes, you can see your chart. Yes, you can see your chart.
Okay, great. So the next thing is to apply the concept I shared with you. So this is the Russell 3000. Let's go to the weekly time frame. So remember, we want the Russell 3000, the stock market index, to be above the 100-week moving average. So in this case, we use the Russell 3000. So I'm just going to go back to the charts and change these settings to 100. Okay, and I'm just going to release this. So you can see that the black line over here is the 100-week moving average. So right now, the Russell 3000 clearly is above the 100-week moving average. So this means is that the overall market is bullish and we can look for potential buying opportunities. But we don't want to just randomly buy stocks. We only want to buy stocks which are in an uptrend. So what we will do is we will then make sure individual stocks are above their 200-day moving average. And how do you do that? Very simple. Go back to the charts. In this case, I'm going to the daily time frame. I will change this to 200. Click OK. And let's look at this Kirkland. Right, you can see that this stock right now, it's above the 200-day moving average. This stock is trading here and the 200-day moving average is here. It's above it. So this stock right now is in an uptrend. Another one. How about APPS? Digital Turbine, right? You can see that this stock is above the 200-day moving average as well. So this is what we're actually looking for. Overall market to be bullish and individual stocks to be bullish as well. And the parameters that we use, again, is a 100-week moving average for the stock market index and 200-day moving average for the individual stock. So next thing, right? So really, if you look at this, right, you can look at this. A simple analogy to give you is the, let's say you like a girl, right? I think most of you here are guys, right? So if you like a girl and the girl loves baking, cupcakes, scones, etc. And let's say you're interested in her. What are the odds of her being interested in you? If let's say you also like to bake, then clearly the odds are with you, right? Because of similar interests, right? Because you guys are having similar interests. You guys are having interest in the same direction. She likes baking, you like baking. Hey, there's a good chance of, things working out. So same thing as the markets, right? If market is in an uptrend, you're looking to buy stocks in an uptrend, there's a good chance of things working out as well. So now, this is for trend, right? Next one, just because the market or stock is in an uptrend doesn't mean you want to blindly hit the buy button, because there's another thing that you want to look for, and it's what we call area of value. So area of value, in essence, right, it tells you where to buy. So trend tells you what to do, to look for buying opportunities or to stay out. Area of value tells you where exactly to buy, because you don't want to just blindly buy when a stock is in an uptrend. It could be overextended. It could be about to make a reversal. It could be, about to make a pullback. So area of value is where you want to trade from. So this could be things like support, swing low, 50-day moving average. So these are really the three things I pay attention to when I trade stocks, right? Whether the stock is at support, is it at the 50-day moving average, or at the swing low. So let me give you an example. So if stock is in an uptrend, okay, stock is in an uptrend, then what you want to look for is for the market to pull back possibly to this swing low or this area of support. This is what we mean by the area of value. So this is really what we are looking for. This is an example of an area of value at a swing low or support. It could also be area of value using the 50-day moving average, especially in healthy trends. So let's say market or stock is in an uptrend, and when you overlay with the 50-day moving average, you find that this stock tends to respect the 50-day moving average. So this is another area of value that you can look to trade from. So now let's have a look at a few chart examples so you can see what I mean. So first one is this one here. Okay. Grow Generation Corporation. So you can see over here, we have this area of value over here. I'm just going to get this tool and to highlight out. Okay, rectangle. Okay, we have this area of support over here. This is an area of value. Another one could be let's see, Vox. In this case, Vox also have this area of value over here. And on top of it, I believe the 50-day moving average is also acting as an area of value for this. Okay, not quite. It actually broke down recently. Okay, so in this case, this is this area of support, right? Is an area of value for this stock right now, and this is where you want to be looking to trade from. So again, you can look at it this way, right? So just because the stock is in an uptrend doesn't mean you want to blindly hit the buy button. Okay, and with that said, let's kind of find out what is the next step. So I'm just going to get rid of the drawing. So the third thing to look for is once the stock is trending higher, once the stock is at an area of value, the third thing you have to look for is an entry trigger. What is the thing that will get you into a trade? So we call this an entry trigger. And for trading, right, entry trigger, in essence, right, tells you when to buy. Okay, when to buy. So if you think about this, the trend tells you what to do. Should I be buying right now or should I be selling? The area of value tells you where to buy. The entry trigger tells you when to buy, the exact time when to buy. Okay, and to do this, right, you can actually look at candlestick patterns. It's actually a very useful tool, right, to help you define your entry trigger. So I'm going to walk you through some basic, simple candlestick patterns that you will encounter in your trading. First one is hammer. A very common pattern. You might even heard of it before, but for those of you that have not, right, I will just explain what this means. So a hammer simply means, right, that for the day, this market has opened at this price. Let's call it O. And then at the start of the day, the sellers were in control. They came in and they pushed the price down lower, all the way down, all the way down near the lows of this day. And then the buyers look at it, they were, saying, hold up, right? That's enough, right? That's as far as you're going to push, right? Now we're in charge and we're going to push the price up higher. So they reverse all the selling that has occurred in the early part of the day, and the buyers push the price up higher. At this point, they decided, no, hey, let's inject some steroids and push it up further. So they push up even higher and close finally near the highs of the day. So you can see that the story behind the hammer is that at the early part of the day, the sellers were in control. They pushed the price down low. And then the buyers stepped in, right, and reversed all the earlier losses and closed higher for the day. So you can see that momentarily, the buyers are in control because they have overwhelmed, right, the earlier selling pressure. So this is what, in essence, the hammer is about. The other pattern to know is what we call the bullish engulfing pattern. And really, it's a very similar concept. The only difference is that it's happening over 2 days. So the first day, bullish engulfing pattern, you can see priced open over here, and then it closed near the lows of the day. So the sellers were, woohoo, right? Time to celebrate, right? This is good news, right? The market is going to collapse. And then next day, somehow the buyers, step in, maybe they took an overdose of, steroids, and they pretty much, push the price up near the highs, even above the highs of the previous day, and the buyers to control and close near the highs of the second day, and the highs of the second day is way above the highs of the previous down day. So in essence, you can see that again, these two patterns, in essence, what it's telling you is that the buyers have stepped in and pushed the price up higher. It has rejected lower prices, right? This is in essence what this two candlestick patterns is telling you. It has rejected lower prices, rejection of lower prices. And of course, one thing to point out is when you study candlestick patterns, it's very important to understand the concept, the meaning behind it. Because when you trade, right, the markets, there are so many variations to it, and you will see later when I give you, more chart examples that, sometimes it might not happen in the form of a hammer or a bullish engulfing pattern. But remember, the key thing that we are trying to look for is rejection of lower prices. We want to see the price come down lower and quickly get rejected and close up higher. That's really what we are looking for. Okay, and so with that said, now that you've understand some basic candlestick patterns, right, the next thing to look for is your exits, right? So now you know when to enter using entry triggers. So now the final part of the equation is exit. When do you exit the trade? So when it comes to exit, right, it tells you in essence, right, when to sell, right? That's a very important thing that you have to cover. You can't just, think, oh, when to buy, because there will be times, often many times, where the market moves against you, and you can't just pray to whoever you believe in and hope the market will reverse from there. No, that's not how it works. You have to have a predefined plan to know when to cut your loss, to exit, right, if the market goes against you. And of course, if the market moves in your favor, you will also need to know when to exit your trade to book your profits. You can't just, hope the market goes to the moon, because, what you can see is that market can go to the moon and then come back to earth and you feel like crap because, you didn't take profits. So exit, right, is two part: when to cut your loss and when to take your profits. So to do that, right, let's first talk about the stop loss part. So when it comes to stop loss, right, your stop loss should be at a level, right, which invalidates your trading setup. So what do I mean by that? So whenever you put on a trade, whether it's stock trading, forex trading, crypto trading, it always have to have like a hypothesis behind it. So let me give you an example. So let's say you're looking to buy at support. Stock is in an uptrend, okay? Retest support, and you look to price bounce up higher, and you look to buy over here. So let me ask you, right, at this point, right, at where, right, will your trading setup get invalidated? At what point, right, will this area of support break down? And if you think about this, right, support is likely to break down possibly at this price point, because if right now the market breaks here, it has broke below support, and this support has now been invalidated, and you want to get out of the trade because support is broken. So when you set your stop loss, it must be at a level which invalidates your trading setup, whether you're using trend line, support, or whatsoever. So this is what we mean by at a level which invalidates your trading setup. Or let me give you another example. Let's say we are dealing with, some of you might be familiar with chart patterns. Let's say head and shoulders pattern like this. Okay, price breaks below support, breaks below the neckline. So at which part, right, at which level on the chart, right, will this head and shoulders pattern be invalidated? Okay, so if you ask me, right, depending on how conservative or aggressive you want to be, if you really want this pattern to be invalidated, your stop loss should go above this extreme high, possibly somewhere over here. Because if the price now breaks down and goes back up higher, clearly this head and shoulders pattern has failed, right? Because no head and shoulders pattern, right, should have the price, breaking out above the head, at some point in the future. So that means the pattern has failed and you want to exit the trade. So this is what we mean by having a stop loss, right, at a level which invalidates your trading setup. Okay, next one. Let's talk about take profit, right? Where do you take profit? Well, you want to take profit before opposing pressure steps in. So there are different ways you can take profit. You can, look to ride a trend in stock markets, or you can look to capture a swing. But for the sake of today's presentation, I'll just go with swing trading, because that's an approach that I believe most traders will benefit from. So how do you become a swing trader? So swing trading, right, in essence, what you want to do is to capture one swing in the market, and you want to capture that one swing before opposing pressure steps in. Like, for example, if I can't think of any example now, but let's say, this is a chart. Okay, let's say you buy near the lows of support. Okay, you buy near the lows of support. The price heads up higher. So where will opposing pressure steps in, assuming that this market is in a range? Well, if you ask me, opposing pressure is likely to step in at resistance, right? Because, resistance is an area where sellers might come in to short the market. So if you want to take profits, it might be prudent to exit right before this sellers come in to take profit before resistance. Don't look to take profit, above the highs of resistance or at resistance itself, because remember, support resistance, they are an area on the chart. There's a good possibility that the price might not reach the highs of resistance before reversing down lower. And if you set your target above the highs of resistance, you're just putting the odds against you. Okay, so we will look at this later in more details as well. So with that said, let's have a look at a few chart example, right, to the things that we have just covered. So if you look at this chart over here, this is Fiverr. Okay, you can see that over here, let's say you were to be buying, let's say the market has rallied from this swing low. Over here, it's rallied higher and you're looking to buy. So where do you set your stop loss? At what point will this area of support be invalidated? So this is where now you want to set a proper stop loss. And to do that, okay, we will go with a tool called the average true range indicator. So just go to indicator, look for ATR, pull out. I like to go with a 20 period ATR because there's 20 trading days in a month. I like to go with SMA because I'm a simple man with a simple needs. Okay, so how do we use this indicator? So if you recall, in the earlier slide presentation, I said that, you want to set your stop loss at a level which invalidates your trading setup. And you saw that, there's actually some buffer you give, right, for the price to break below support before you exit the trade. Because you don't want to set your stop loss just smack under support like this. In this case, let's say you just set it just below this lows. Because what could happen is that the price could just come down lower, bounce into support, and then continue higher from there. And then if you set your stop loss just below it, you get stopped up prematurely. You don't want that. So give it some buffer. And to know how much buffer to give, right, this is where the tool, right, like the average true range comes into play. So let me just explain to you how this works. So at the average true range value right now, it's about $15.06, as you see over here. So what this means, right, is that historically this stock Fiverr over the last 20 days, it has moved an average of $15.06 on each day. The range of the day between the highs and lows is about $15. So when you set your stop loss, what you want to do is to then first and foremost find out what's the low of this support, what's the low of this swing low. So let me just see. Let's say the low in this case it's about $129.21. Okay, for the low of this this candle, 129.21. So you take $129.21 minus $15.06, which is 1 ATR. So I got a calculator with me, 129.21 minus 15.06. And it gives me a value of about $114.20. So if I were to plot my stop loss, it will be somewhere about here. Okay, that's the wrong tool to use. Let me find the right one. Okay, never mind. Okay, $114.20 here. Okay, that's where my stop loss will be. And in this case, I'll just go with a red color to signify stop loss. There you have it. So this is where my stop loss will be for this particular setup or trade, if you want to call it. So from this low, from here, this low to this point is 1 ATR. And you know the 1 ATR value is about $15.06 as shown over here. So this is the buffer that we give for our stop loss, just in case the price spiked through below support and then reverse from there. So we have some buffer, right, to give us this so-called protection. So let's have a look at, I don't think we need to look at another example because later in the trading example section, we'll go through this once again. So now next thing that we want to talk about is, where do you exit your trade? Okay, so let's have a look at this chart over here. So let's say, for whatever reason, let's say, price has come into this area of swing low support, had this price rejection. Let's say you buy, you go long. So now where do you exit your trade? So imagine now that you're long, right? You're in this long trade. Where do you think opposing pressure will step in? So recall, right? We mentioned that, opposing pressure, if you have forgot, right? You want to exit your trade before opposing pressure steps in. And it's usually before resistance, before swing high. So in this case, you can see that this is a nearest swing high. So you want to exit your trade before this swing high over here. You don't want to have your target above this highs. No doubt, right? In this case, you would have, made a profit. But again, what if the price doesn't retest this high? What if it just comes up higher and then reverse from there? Then you will have, watch your winner become loser. So this is why we want to set our target before the nearest swing high or before resistance. So now that you have understood what I've shared with you, let's have a look at some examples, right, to take into account the different concepts that we have spoke about earlier. So first, to start with, okay, first example, I'll share with you winners and losers so you kind of know what to expect when you're doing this on your own. So first one is Kirkland. So if you look at this, okay, this is remember what I shared with you, the few things to look for is number one, the trend. So let's just assume that the overall broad-based market is in an uptrend, right, to make things easier. So the next thing that we're looking for is to make sure that the individual stock is in an uptrend. So we overlay with the 200 period moving average, as we see over here. Price is above it, great, we can look for buying opportunities. So in this case, the stock come towards an area of value. And what you can see that, yes, it did come into this area of value, this area of support. And not only that, right, it has the confluence of the 50-day moving average as well. Pretty sweet, right? When you have area of support having a confluence of the 50-day moving average, and that 50-day moving average, is respected by the market, like, it tested once, twice, 3 times, right? And here, a 4th time, right? You can see that this really is, it really sweetens the deal a lot. So yes, the stock is at this area of value. In this case, it's, let's call it just S plus M, okay, SM. And the third thing, do we have an entry trigger? So in this case, if you look at this, remember I said that, when we talk about candlestick patterns, right, there's no point trying to memorize each individual pattern because in the real world of trading, the pattern might have slight variations to it. So in this case, we have something that looks like a hammer, but only difference is that it closed slightly lower for the day. But still, I consider this a price rejection, a rejection of lower prices. And, it's perfectly, to me, it's a valid setup. And you can look to buy on the next day open. So let's say the next day in market open at this price. It opened here. So you can go long on the next day open. Stop loss, remember, we like to set it 1 ATR below the low. So let's say this is the nearest, this is the low of support. We set it 1 ATR below it. So again, let's just pull out our ATR indicator. Just full ATR. I like to go with a 20 period. Oh, it's already there. So I'm just going to close this. So over here, so you can see that the current ATR value is about $2.90, as shown over here. So what you'll do is you find out what's the lowest price point and minus 1 ATR. So in this case, the lowest price point for this candle, it's about $20.69. Okay, so $20.69. You minus, let's say, $2.90, $20.69. You minus, okay, in this case, the current ATR is 286. You minus 286. It's about $17.83. So you just pull out your stop loss tool. I mean, this is a horizontal line, and your stop loss will be at $17.83. So in this case, $17.83. Click OK. So this is where your stop loss will be. Your stop loss, right? So let's say if you enter on next day open, which is this candle here. Next day open, okay. Stop loss is at this red line. So now what about your target? You already have defined, right, your exit in case the market moves against you. Now, what if the market moves in your favor? Where will you exit your trade? So let's say this one here. I can't see this. Right, this is the rate is stop loss. This black line here is entry. Where would you exit if the market moves in your favor? So remember, from a swing trading perspective, we want to exit our trade before opposing pressure steps in. And you can identify that this is the recent swing high. So sellers might come in at around $32 price point, exit selling pressure in this market. So to me, it makes sense to, have your target profit before $32, maybe somewhere about here in this case. Okay, so let's see. In this case, clearly this is a winning trade. As the market has, rallied higher and pretty much would have, hit your target. So this is how the concepts which I've shared with you, how it works. So let's have a look at a few more examples before we kind of, sum it up. Next one is Etsy. So I'm not going to walk you through the stop loss calculation because I think it's quite straightforward. So Etsy is another one over here. You can see in this case, stock is in an uptrend. right? It came into this area of value, this area of support. I believe it has the confluence of the 50-day moving average as well. As you can see, it did break below it. But remember, one thing to point out is when you are identifying your areas of value, right? Remember, it's an area on your chart, not a single line. So in this case, the 50-day moving average, notice how the price, tends to come in towards this area of value, then hit higher, breaks below it, hit higher. In this case, it breaks below it and then hit higher as well. So again, you have to expect this, right? In your own trading, we are dealing with an area of value, not a line on the chart. So in this case, you can see, again, we have the number trend. That's one. Trend, that's one. Trend is uptrend. Number two, we have the area of value at support. And number three, our entry trigger. In this case, we have something that looks like a hammer. Again, it closed slightly lower for the day, but I would say this is bullish because it shows you rejection of lower prices. Look how much the price at one point in time, it was trading near these lows, only to get overwhelmed by the buyers to reverse and close near the opening price of the day. So I would say this is a rejection of lower prices. So you can call this I won't call this I'll say a hammer, close to a hammer. Let's call it a ham then. Ham is close to a hammer. And you enter on the next day open. Okay, so next day open at this price point over here. Okay, now what about stop loss? Again, we know it's 1 ATR below this low, so I'm going to guess it's probably somewhere about here. It's your stop loss. As for target, we want to exit before opposing pressure steps in. And if you look at this, this is the recent swing high. We want to exit around the $240 price point, somewhere about there. Okay. Next example, we can have a look at Upwork. Okay, we talked about that earlier, but we can look at this example as well. So Upwork, again, this one here, same concept. Stock is in an uptrend, as you can see over here. It's definitely above the 200-day moving average. Area of value is this over here, this swing low support. And then number three, we have this. Now, this doesn't look like a ham. It looks like a hammer. Right? This is a hammer. Okay, so we can enter on the next day open. If this has a valid entry trigger. So next day open, we enter on the opening price here. Stop loss again, 1 ATR below this lows. Target again just before this most recent swing high. And let's have a look at one more example. In this case, it's actually a losing trade, but I just want to prepare you to the reality of trading. It's not always going to be winner. There will be losers along the way. So in this case, you can see that this is Zoom. In fact, I really like this setup a lot. I thought it's really a good, legitimate setup. Number one, uptrend. Area of value, you have this swing low plus 50-day moving average. You can see over here. Actually, it's an area of support, right? Support tested once, twice over here with the 50-day moving average. So we have this area of value, or rather two area of value. And then we have this entry trigger. In this case, we have a gap up. You can see over here. This candle here, it gap up and close near the highs of the day. So that's nice as well. So over here will be our entry trigger. Enter on the next day open, which is somewhere here. Stop loss will be 1 ATR below this lows, probably somewhere here. And your target, right, just before the most recent swing high, possibly somewhere about here is your target. So again, in this case, the trade didn't quite work out. It pretty much collapsed and it got stopped out. So that's pretty much it, right? So those are a few examples to share with you, so you know what to expect, when you're doing this on your own. And now the question is, hey Rayner, there are thousands of stocks out there in the US stock markets. How do we find such trading opportunities, right? Every chart that you pick is all in an uptrend, Rayner. Do I need to have some cheat code to find a way to it? So yeah, the cheat code is this. How do you actually quickly scan for trading opportunities? And the best part, you don't need any software tools or any paid scanners. I'm going to share with you how to do it. So the way you're going to do it is you go to this website called Finviz, right? It's just go finviz.com. I'll just walk you through so you can see how this works. Okay, so when you go to the website Finviz, it looks something like this. And you go click on screener. So I'm going to walk you through step by step. So on this screener page, there are three things that you want to look for. So first thing you want to look for is the market cap of the stock. I don't want to be trading, micro stocks or, penny stocks and stuff like that. I want to be trading the more liquid stocks. So I use it a filter as the mid, right? Anything above $2 billion. I am perfectly comfortable trading it. The next filter that you want to use is under the technical part. Okay, the first one was a descriptive filter. Now the technical filter. You want to make sure that the 52-week high-low, which is this one over here, you want the stock, right, to be 5% or more below the high. So this means that the stock is now currently making a pullback, right, away from the 52-week high, at least 5% or more. And the final thing that you want is your performance, right? You don't just want any Tom, Dick, Harry stock. Remember, we want to be trading stocks which are in an uptrend. We want to be trading the strongest stocks. So what you can do is to pretty much look for performance. Any stocks, right, that for the year has increased more than 200%. Right, you want to be focusing on this stock. So again, this parameter here can be a little bit subjective because it depends on the current nature of the market. If let's say the market now is in an insanely strong bull market, then you want to be more picky with your setups. You can maybe choose only stocks that has increased more than 500% over the past 1 year. But if the market is a bit choppy, up and down, not really going anywhere, you can adjust your this parameter accordingly. But in this case, right now I'm going to go with stocks, right, that has increased, right, at least, right, 300% over the past 1 year. Okay, and once you've done it, ta-da, what's going to do is that it will spit out to you all the stocks. So let me just share with you how to actually use this. So we go to company. We want to see the okay, can't remember this. What is it? Technical performance. Okay, click performance. So once you have performance, you can see the strongest stocks, right, rank all the way to the lowest one. So in this case, you have just 4 or 5 fields to look at. So in this case, let me see. You want to rank the stocks from the strongest to the weakest, and what you want to do is to click. You see this one over here? You click on this. Now it's the bottom one right at the top. So this stock, Sono, has increased 301%. If you click it one more time, it has ranked the strongest one, Mara, right at the top, right, 6,840%. So it ranks from the strongest all the way down to the weakest ones. So what's there left to do? Very simple. If you can just go to this tool over here, you look at Mara, it pops up a little bit of chart, a glimpse of a chart. That you can see what the chart is like. So if you look at this one glimpse, right, you can know instantly, is this stock in an uptrend or not? If it's in an uptrend, you can add it to your watch list. If it's not, then just move on to the next one. Look at Riot. So seems to be an uptrend, fair enough. APPS, we had this earlier. I just want to show you a better example. If you look at this OSTK, this one clearly is not in an uptrend. So move on, don't bother adding this to your watch list. This one, bad example, don't add it to your watch list because this stock is not in an uptrend. Based on the chart that you see, the chart that pop up, you can see that it's not in an uptrend. Next one, SI, not too bad, maybe might pass. We can add this to our watch list. EXPI, this stock is pretty much looking like in a downtrend or range. Let's leave it. So what you want to do is all these potential stocks which are in an uptrend, add it to your own watch list. And this is actually what I do myself. You can see over here, I have a watch list of stocks, which are pretty much, all over here. Okay, and out of this watch list are pretty much stocks, right, which are in an uptrend. Let me show you. Kirkland, stocks in an uptrend. APPS, GRWG, IBRX, PEN. Okay, so once you have all these stocks in your watch list which are in an uptrend, what's next? Well, the only thing that's left to do is to let the market come to you, let it come to your area of value. That's all you need to, look for the upcoming week. So in this case, let me just share with you a few trading opportunities that I'm looking at for this coming week. And again, it's using the same concepts, the same strategies that I've shared with you. It's all from this free scanner over here. Okay, I've just, spent some time on the weekend, and you can pretty much, get all this potential trading setups worth trading. So let me share with you. Let's have a look at this, right? So I have prepared a few. HRI, this is one upcoming trading setup. Okay, so if you just overlay the 50-day moving average, you can see this is a stock in an uptrend. How did I find this stock, HRI? If you go to the scanner, the scanner is here. Where is HRI? I believe it's somewhere here because I just scanned this earlier. Let's find this HRI. There it is, number 54, HRI. This is not magic. This is not voodoo. This is a step-by-step process, right, to make your trading life easier and hopefully, get you trading results. Okay, I'm not holding anything back. So there you have it, right, HRI. So what I'm looking for this stock for this upcoming week is, again, this is the area of value worth looking at, and this is the 50-day moving average that also this market that seems to be respecting it, right? Tested a number of times, almost once, twice, 3 times, 4 times, 5 times, possibly a 5th time over here, and we have this confluence of this swing low over here. So what I'm looking for this coming week or the next few weeks is for the price to come into this area of value and reject it, right? You could be in the form of a hammer, a bullish engulfing pattern. The stronger the price rejection, the better. Then I will set my stop loss 1 ATR below the swing low, as what I've just shared with you. As for targets, right, I usually like to, take partial profits before the swing high and to ride the remaining half, right, to ride the trend. So this again, right, it's not a topic to cover in today's webinar because I'm actually, short of time. But again, you can actually look for all this resource materials on my website or, my book, which you can read. So anyway, moving on, another example, Sono. So this one over here, Sono, you can see same concept. Stock is in an uptrend, overlay with the 50-day moving average. You have this area that's worth trading from around the $35 price point, near this area of support, near this 50-day moving average, which is also acting as a confluence. So looking for a bullish price rejection, for the price comes in, quickly reject it, close up higher, looking to enter on the next candle open. Stop loss can go 1 ATR below this lows. Target just before the swing high. I'll just walk you through a few examples before we call it a session. Next one over here, FCX, same concept. This one actually here, there's a valid trading setup. And one thing to point out, if you're going to take this trading setup, whether you make money, whether you lose money, it's all on you. It's all on your responsibility. I will not be responsible for it. All right, you are a wise adult. You can be accountable, and all this is just for educational purposes. So you can see over here for this stock, there's actually a valid trading setup right now. Price came into this area of support, and then on Friday it gapped and closed right near, I'll say near the middle of the range. But I'll see it's slightly bullish as it has a green color annotation to it. Closes, bullishly, and it has rejected this area of support. So what you can do is come Monday, you can look to enter on the next candle open. Stop loss can go 1 ATR again below this low somewhere here. Your first possible target can go just around before the $38 price point. So this is a free pot. Another one. This is a Caesars Entertainment. So again, same thing. We have a valid trading setup. You can see the price came into this swing low. 50-day moving average confluence plus this swing low. We have a bullish engulfing pattern. This one was on a Thursday. Friday closed slightly bearishly, but still, hey, it's a valid trading setup that you can take. Can enter on Monday. Stop loss 1 ATR below this lows. Target just before this swing high. And what I've shared with you, again, it's not just applicable to stock trading. You can apply to Forex, as well, or futures. So I'm going to share with you a few Forex pairs so you can see what I mean. So next one, dollar yen. In this case, we'll have a look at the 8-hour time frame. You can see that this market is in an uptrend. This is the area of value that I'm looking at for a possible retest. Bullish price rejection. Looking to enter on next candle open. Stop loss can go 1 ATR below this lows. Possible target before this swing high. Another example, euro against the British pound. Same concept. This is the 8-hour time frame. You can see that this market now is in a downtrend. So again, this is the area of value, right? Looking for a retest of this resistance. Can get a bearish price rejection. Can look to sell on the next candle open. So really the strategies, the concepts that you've just learned can be applied to the other markets as well. So don't forget, the trend, the area of value, the entry trigger, the stop loss, and the targets, which I've shared with you earlier. So with that said, right, let's move on. So we also talk about the scanner. That's great. So we talk about the potential trading opportunities. So at this point, right, we have cover quite a bit. We talk about the 3 secrets. Number one, it's far easier to make money from stock trading when the stock is in an uptrend, right, not in a downtrend. Number two, we talk about a trend filter, right? How a trend filter can help you, improve your returns and reduce your risk. And number three, it's important to have an edge in the markets. There we spoke about the TAE formula, right? Identifying trends, identifying area of value, having an entry trigger, and having exits for every single trade that you put on. So what you've just learned, right, is in essence what we call price action trading. And if you want to learn more about price action trading, I've actually written a book called Price Action Trading Secrets. It might interest you. If you've enjoyed this webinar presentation so far, then this book is something that you'll definitely love as well. So this is actually a 140-page color trading book that teaches you how to be a consistently profitable trader. Don't have to rely on fundamental news, indicators, or signal services. Yes, we use a few indicators here and there, but they are not essential. Those are like secondary, supplementary stuff. So couple of comments that we have, right? For example, Mark, right? Best for those who are still losing money since they started trading. I have been trading for more than 3 years now, but still losing money. I've studied and learned complex indicators in the hopes of turning my account to positive, but no luck. So after I read the price action book, he has, become profitable, limit his losses from 30% drawdown. Now it's positive. And the good thing is I ditch all those indicators and stick with price action. Another one from Ben. Okay, I purchased the price action trading secrets from Rayner about 6 weeks ago. I like his YouTube content. I highly recommend the book. So this person, Ben, he trades on the Australian stock market. And by using what I learned from the book, I've so far made 5 successful trades, all between 10% and 30% profit. I know that's not typical, but info has helped me notice opportunities and feel confident to take them on my own. So what you learn in the book, right, is number one, professional price action trading strategies that allows you to profit in bull and bear markets. So when you trade stocks, I recommend trading only in uptrends. Right, in downtrend, stay out of the market, remain in cash. But when you trade Forex and futures, you can also make money in bear markets in the downside. You learn how to tell when support resistance is about to break so you don't get caught on the wrong side of the move. You learn how to write massive trends, right, in bull and bear markets. You learn how to enter a breakout before the breakout. And it comes with 70 plus charts and examples, right? So the concepts, the strategies, right, is really hammered strongly right into your head because the charts is very well illustrated and it's clear and easy to understand. So again, some people like Peter, right, he has improved the win-loss ratio by 25%, and we have Jason who has improved his winning rate by 46%. So if you get this book, right, bonus number one is you also get a PDF copy of this Price Action Trading Secrets book. So this is a physical trading book, but if you purchase it today, I'll also send you the digital version so you can just read it instantly, right, without having to wait for your book to arrive. You will also get a position sizing calculator so you never blow up another trading account, because as mentioned, right, you have to know how many shares to buy, right? You can't just buy a fixed 100 shares, because 100 shares on Amazon and 100 shares on Coca-Cola is different value on your portfolio. And if you just buy 100 shares blindly, you'll find that your portfolio will have very erratic swings. So this position sizes calculator is meant to help you with it. And bonus 3, you get this webinar called Part-Time Trading Secrets, basically to help those of you who are currently trading part-time, how you can actually trade profitably and consistently. So as a quick recap, right, what you'll get is a physical copy of Price Action Trading Secrets, the PDF version of it, you get the position sizing calculator so you never blow up another account, and the Part-Time Trading Secrets webinar. Total value at least $700, but for today, if you want to invest in it, it's only $18.90. By the way, it's a physical book, and this includes your shipping as well. So you can get your copy at this link over here, or if you want to use a QR code scanner, this will help as well. Okay. So I think, yeah, that's pretty much it for me. I don't really have anything else to add. So if the host is listening right now, you can actually help facilitate the Q&A if there's any.
Yes, all right. Thank you, Rayner, for your wonderful session. Right. So if you guys can see, I already posted the link in the chat box as well. This is only $18.90. All right. It's just less than a meal at a restaurant. So you get so much value. Just a recap here, you get 3 bonuses: the PDF copy, the position sizing calculator, and a part-time trading secrets webinar. So all this is just only for $18.90 US dollars, right? Is that right? US dollar, right, Rayner?
That's right. It's all in USD.
Yeah, so just go ahead and purchase the book. There's so much value in this his book over here. I'll post the link one more time because there are some comments out there. All right, so you can see the link. Okay, so maybe we have some time. We'll go through the Q&A. Let me go through some of them. All right, so if you guys are getting good value from this session, you want to type a yes in the comments so that we know that you are listening well in this session. All right, so let me see. I think somebody asked, what is ATR? I believe there are some newbies out there here, so they don't know what's ATR. So maybe we're going to explain what is ATR.
Okay, it actually stands for average true range indicator. You can actually go to my YouTube channel and search ATR Rayner Teo. You have a very in-depth explanation, but for now, a brief explanation is that ATR measures the historical volatility of the market, and we use that tool, or I use that tool, right, to help me set a proper stop loss. So I want to set my stop loss, right, without getting stopped out from the noise of the market. So the ATR indicator tells me, right, how much buffer I should use, right, so that my stop loss is large enough, right, to take into account the swings of the market. So I use the ATR indicator for it. But again, if you want more information, just Google, Rayner Teo ATR, something like that. Either a video or blog post will pop up.
Okay, so you mentioned about the ATR as a buffer. Of course, Suraj is asking, right, the best way to follow the stop loss, is it a swing low or 1 ATR? So personally, I know you recommended 1 ATR, but what if he want to put at the swing low? Do you recommend that?
Personally, I don't do that, but if you want to, I can't say it's wrong either. I think having a stop loss there is better than no stop loss. But personally, I usually give it at least buffer. 1 ATR. Yeah, 1 ATR below it.
Yeah, all right. So Suraj, I hope that answer your question.
Sorry, just to interrupt, right? Sorry to interrupt. If you really want to set it 1 ATR below that swing low, then make sure that the price has recently take out the lows of support. Like for example, earlier the chart examples, you saw that the candle came down, it has swept below the lows of support and then it reverses up higher from there. So when that happens, okay, fair enough. You can actually set your stop loss just below that swing low, since the so-called stop hunt on the rate of support, right, has just occurred recently and it's unlikely to do so again. So that's fair enough if you want to set your stop loss just below the swing low when that happens.
All right, so Ivan is asking a good question. So can a Malaysian buy? So does the book deliver internationally?
Yes, the book delivers internationally to everywhere around the world.
So it only costs 18.90 to deliver anywhere in the world, right?
Yes, that's right, 18.90 USD. And bear in mind, you please give us 4 weeks to ship, because the book doesn't come from Singapore; it comes from the US. So we have some a logistic team down there to help us facilitate the shipment of the book. So if you're from US, it reaches you even faster. But if you're in Asia like me, the book give it about 4 weeks to reach you. And the good news is that the PDF copy is instant. Once you purchase it, the instant PDF copy is sent to your email directly, so you can choose to read it instantly if you wish to.
All right, so wonderful. So you heard that already. So if you are living in Singapore, Malaysia, Philippines, US, UK, whatever country you are in, right, you can just buy the book and it delivered to your home. All right, so let me see. You mentioned about the area of value of 50 MA. Brian is asking, how about 20 MA? Is it applicable as well?
Yes, I would say the 20 MA is applicable as well, and that's usually for very strong stocks that has little to no pullback. Usually for those stocks with 50-day moving average, the pullback is much more clearer, much more defined. For the 20-day moving average one, the pullback usually is more short-lived, and you got to be more reactive. You got to react faster to it. Whereas compared to the 50-day moving average, since the pullback is of greater depth, right, you have more time to plan your trade and react accordingly to it.
All right, so Amos is asking about your outlook, right? Any insights on the Nasdaq tech stocks, short-term, long-term trend, right? This can be a bit subjective. Do you have any views on the current tech correction?
Okay, so really, I'm really very boring and objective when it comes to the trend. So as mentioned earlier, since now the broad-based market index, they're all still above the 100-week moving average, I still look for buying opportunities. I'm not going to stay in cash or short the markets. I don't short stocks at all. So my long-term bias is still bullish. However, with that said, right, short-term wise, I'm noticing that even though, like for example, the S&P 500 has closed bullishly right yesterday, a number of stocks has reached nowhere near their high. So I'm seeing weakness right in a number of US stocks, individual stocks, but the market is still reaching out to new highs. So I see a lot of weakness in I'll say short-term weakness in individual stocks, whereas the market is still showing signs of strength approaching the new high. So there's kind of like a little bit of a discrepancy down here, if you want to call it.
All right. So Ivan is also asking, is the 50 MA applicable also for Forex? On
Yes.
all markets?
So here's the thing, right? The 50 MA is nothing magical about it. The 50 MA just simply help us to define the type of trends to trade. So for 50 MA, I find that the type of trends you get is usually what I call a healthy trend, where the market, rallies up higher, makes a decent pullback. The pullback is not very short where, you can't time an entry and before it continues higher. The pullback is usually decent in the sense that you can actually see the pullback, right, occurring, day after day, right, until the point where it reaches your area of value, and then you can look for an entry trigger to trade. So a 50-day moving average pretty much helps you classify this type of trend. Is what I call a healthy trend. So it can be, seen across different markets, but bear in mind, it's nothing magical about a 50-day moving average. You can use 49, 51, 52. The concept is pretty much the what I just shared with you. The concept is really what matters, is to help you define the type of trends that you want to trade.
All right, so there are a few people asking whether we have a recording of this session. The answer is yes. Okay, so we will send you the replay after the submit. And a few also asking, how can you screen the stock at the FinViz? We are running short of time, so I suggest that you can go through the replay once again, and you go through the Rayner session, and he'll show you how to screen for the stocks at the FinViz screener. All right, Jeremiah, are you there?
Yes. So thank you so much, Alex and Rayner, for the engaging Q&A. I definitely want to say, Rayner, a big thank you to you, because I learned a couple of things as well that's going to be useful in my own journey. So I think that's something that's really helpful, not only for me, but also for all the attendees that are here watching the session. Rayner, thank you so much once again for taking your time out. I really appreciate it. And the session was definitely a great one. And one piece of advice, I looking at the book price and looking at all of the benefits that I see for $18, it's kind of a no-brainer for the amount of knowledge that I think you can get from that. So I do highly encourage you to do that. I think Alex just resent the link to the book purchase. So please go ahead and purchase the book if that's something that is you're interested interested in. For the rest of our attendees, we have a second session following out after Rayner's session, and this session is by Dawn, who is the founder of SG Budget Babe. She will be talking about technology stocks in particular, which has been getting quite a little bit of hype in the last couple of weeks, and whether they're still worth investing in. So that's going to be happening in a different Zoom room, for which Alex will help me to send out the Zoom link over here.
I just posted in the chat box. All right. So once again, we are not going to stay in this room. Please go ahead to the next room. And if you are following us on Facebook or Telegram channel, we are also posting all this link in those channels as well. All right. So once again, I'll just repost, okay, the link for Rayner's book, just in case overwrite the comments over here just one more time. All right, let me post it in the comments, and also the link for Dawn's session, technology stock still worth investing in. I think this is something that you guys will be very interested, because I think a lot of you guys are still invested in the tech, and the tech are coming down recently. So you should be watching this session later. All right, so thank you, Rayner, for your wonderful session today. Thank you for sharing us. I will see you guys again later. Okay.
You're most welcome. Thank you so much for having me. Bye-bye. Stay safe.
All right, see you, Rayner. Bye-bye. And for us, right, and Jeremiah will see you in the next room. All right, I'll end the session right now. Bye-bye.